Now we will see some basic accounting terminologies. So this is one of the important subtopic of this chapter. Here the first part is about transaction and its types. So what is transaction? Now when you exchange goods or services and both the parties agree, there's a mutual agreement between both the parties for the exchange of goods or services for money or money's worth, something similar to money, that is known as transaction. Now transactions are also of two types. One is monetary transaction and another is non-monetary transactions. So what happens in monetary? When the exchange of goods and services take place and the involvement here is about money or money's worth, directly or indirectly, that is known as monetary transaction. Then there is non-monetary, means your money will not come into the picture. So how goods and services will be exchanged? Now there is one thing known as barter transaction. What happens in barter transaction? The exchange take place as one thing over another thing. Like if you want milk, then you can give vessel to a person and that person will give you milk. That is barter transaction. That comes under non-monetary transactions. And in monetary transaction there will be cash transactions and credit transactions. So what is cash transactions? On the spot cash payment or cash receipt, that is cash transaction. For example, paid salary rupees 5,000, that is cash transaction. Or received cash for the goods sold rupees 10,000, so that is cash transaction. That comes under monetary part. Then there is credit transactions. Now when payment or income is supposed to receive after some time, that is known as credit transaction. For example, goods of rupees 10,000 sold to Mr. Y. Now there is no mention of cash here, just the amount is given with the name of that person, so it means it is credit transaction. Or goods purchased rupees 1,000 from Mr. Sharma on credit, so that is credit transaction. That comes under monetary transaction. Then next is goods. Now what is goods? The term goods refers to merchandise, commodities, articles or things in which a trader trades. These are purchased or manufactured for the purpose of sale and to earn profit. Now for example, if you have a bookstore, then books are goods for you because you are going to sell those books to the customer. Why? To earn profit. So goods are not the things which we are going to use for the self-consumption, but goods are those commodities or articles which we are going to sell for earning profit. For example, medicines are goods for chemist, vegetables are goods for the vegetable vendor. The next is entry and narration. Now what is entry? Recording of a business transaction in the proper form or method in the books of accounts is called an entry. Now whatever transactions occurs in the business, when you record it, that is known as entry. Now after every entry you have to write explanation about it. Then what is the meaning of that entry? That explanation is known as narration. So a brief explanation of the business transaction for which an entry is passed is called as narration. So how you write this narration? It is always given in a bracket below the journal entry, and it usually starts with the word being or for. Now this narration and this entry we will see in one of the chapters named as journal entries from this syllabus. Then next is capital and drawings, two important concepts in accountancy. So what is capital? The total amount invested into the business by the owner is called capital. So whatever amount is invested in the business by the owner itself, that is capital. Excess of assets over liabilities is also called as capital. So if you are having more assets, assets means property, and you are having less liabilities, that is amount payable, then it is equal to capital. So here is one formula: capital is equal to assets minus liability. Then there is drawings. Here drawings means when the amount of cash or value of goods, assets, etc. withdrawn from the business by the owner for personal use, called as drawings. So your personal use is important word. When you withdraw amount or any assets from a business for the personal use, that is drawings. For example, if you have withdrawn rupees 5,000 to pay tuition fees of your son or daughter, that is drawings. But if you have withdrawn rupees 5,000 from your business to pay salary to your staff, that is not drawing, that is expenses for the business. So your personal use is important. Then next is debtors, creditors, bad debts. Very important. First is debtor, a person who has to pay to the businesses for getting goods or and services on credit is known as debtor. A debtor is a person who owes money to the business. Now imagine there are two people, A and B. Now A is purchased goods from B on credit. Now A is supposed to pay the amount back to B on future date. So for B, A is known as debtor because A will pay the amount. So A is known as debtor. Now what is creditor? A person to whom business has to pay for getting goods or services on credit is known as creditor. A creditor is a person to whom business owes money. Now when business purchases any goods or services on credit without paying any money, so now business has to pay money to the person, that another person is known as creditor. Then bad debts, if you haven't received any amount in that particular financial year, for example, you are a businessman, you are having a smartphone shop, you have sold one smartphone to a person and that person didn't pay you cash or didn't pay you any amount. So that amount is known as bad debts because that is a loss for the business and it is also known as irrecoverable amount. Then next part is expenditure and types of expenditure. Very important part. Now there are three types of expenditure. One is capital expenditure, then there is revenue expenditure and deferred revenue expenditure. So what happens in capital expenditure? When you do expenses to acquire, means to purchase fixed assets or to increase the value of fixed asset. Fixed asset means all those assets which will stay in your business for a longer period of time, and with the help of those assets you can earn more in your business, like machinery, land and building, computer, motor car. These are fixed assets. So whatever expenses you do to purchase fixed asset is known as capital expenditure, and it is non-recurring in nature, means you will not do such expenditure again and again. For example, if you buy a land or building, then you are not going to purchase land and building again and again. Okay, so here the example are purchase of machinery, extension of building, purchase of computer, etc. Then there are revenue expenditure. So these are those expenditure which are recurring in nature. All the benefits of such expenditure may be for less than 1 year. For example, whatever salary you pay to your staff, your rent expenses, your stationery expenses, expenses for advertisement expenses, etc. Then there are deferred revenue. So this revenue are basically type of revenue expenditure, but here the benefit of such expenses will be for more than 1 year. For example, heavy expenditure on advertising, like you did expenditure for 2-3 years, or heavy legal expenses. Whatever heavy legal expenses you will do, it will help your business for a longer period of time, or large scale expenses for any different purposes. All these things will come under deferred revenue expenditure. Cash discount and trade discount. So the two important concepts here. One is trade discount. It is an allowance given on catalog price or list price of goods. This discount is allowed at a time of purchase or sale of goods. Then there is cash discount. It is the amount deducted from the final amount due at the time of receipt. It is a concession given for encouraging prompt payment. So let's take one example and understand it. Now there is Mr. Shyam. Shyam wants to purchase books. So Shyam went to a wholesaler and he said, I want to purchase 1000 books. I'm purchasing all those books on credit. Now, as I'm purchasing those books in bulk, can you offer me some discount? So the wholesaler said, yes, I will give you some discount on it. That discount is known as trade discount. If the value of those 1000 books were 1 lakh, so the wholesaler said, I will give you discount of 10,000. That 10,000 is trade discount. But after 2 months, you pay me the entire amount, that is 90,000. So value of goods will be now 90,000. Trade discount is 10,000. Now the time given to Shyam was 2 months. But after 1 month only, the wholesaler asked for the prompt payment. He asked Shyam, can you pay me the amount immediately? If you pay me the amount today, I will give you additional 5,000 discount. Why? Because you are paying me cash immediately. That 5,000 for the prompt payment is known as cash discount. So Shyam went to the wholesaler, paid 85,000. He got additional discount as 5,000 for the payment of cash immediately. That is cash discount. So now the value of the entire goods which Shyam purchased will be around 85,000. So this is a concept of trade discount and cash discount. Now cash discount you have to record in the books of accounts, while trade discount there is no need to record trade discount. How? There is one chapter, journal entry, there we will see how to calculate trade discount and cash discount. Then next is solvent and insolvent. So what is solvent? Now if a person is having more assets, more property than liabilities, or his assets are equal to liabilities, that person is known as solvent person. The insolvent is what? A person whose liabilities are more and assets are less. He is unable to pay his debt. Such person is known as insolvent person. Now accounting year. Now as per the income tax rules of our country, India, the accounting year starts from 1st April and ends on next year's 31st March. At the end of accounting year, a proprietor has to prepare trading account, profit and loss account and balance sheet to find out the financial position of the firm. So this is very important part, and there is one chapter about final accounts where we will study in detail how to make these two accounts and balance sheet. The next is trading concern and not for profit concern. So in simple, all those organizations which do business or which sells goods or services to earn profit, the main objective is to earn profit, are known as trading concerns. It is also called as commercial organization or profit making organization. Then there are not for profit concern. All those organizations whose main objective is not to earn profit but to provide service to the society, those are known as not for profit concerns. For example, if there is a hospital, the main purpose of a hospital is to provide service or to provide proper healthcare system to the citizen, not to earn profit. The main objective of schools will be to provide education but not to earn profit. These are known as not for profit concern. Goodwill. Now goodwill is the reputation of business expressed in terms of money. Goodwill is an intangible asset. So goodwill is a type of property for any business. With the help of goodwill, the business can earn more profit. For example, the business is owned by Tata or Reliance has goodwill. Why? Because of the quality of its product and services, customer satisfaction, skills of their staff and quality of management. And due to the goodwill, these companies earn profit or get more businesses. Hence it is known as intangible asset. Intangible means now goodwill, you can't see goodwill. Okay, but it is a property for any business. With the help of goodwill, a business can earn more profit. Then profit, loss, income, revenue. So we know what is profit when selling price is more than cost price, that is profit. Profit, if profit increases, then capital will also increase of the business. Then loss, if cost price is more and selling price is less, that is loss. When there is loss, what will happen? Your capital will decrease. Then income, whatever revenue which arising as a result of business transactions are known as income. Now all those income or revenue you received from different services, like you got from interest, dividend, commission, etc., that is income. Now what is revenue? Now the actual income which you receive by selling goods or services to customer, that is revenue. Now assets, any physical thing or right owned that has monetary value is called as asset. The ownership of the asset must be with business unit. So now the property of business or property owned or possessed by the business and which has a monetary value, means you can express in terms of money, is known as assets. So what could be the asset for any business? Their machinery, their land and buildings, their cash, that will be their asset. Motor vehicle, then computers, laptops, telephones, etc. Then now there are three main types of assets. One is fixed assets. So fixed assets are those assets which are fixed by nature and give long-term benefit to a business. For example, land, machinery, buildings, etc. Then there are current assets. Current assets are those assets which we use to manage our day-to-day or regular activities, and such assets can be easily converted into cash, such as debtors, it is amount receivable, even that is your asset, it gets changed every year. They are flexible, or we can say dynamic in nature. Then there is cash, and there could be stock of goods, etc. There is fictitious asset. So all those assets which gives you benefit for a longer period of time, say for the period of more than 5 years. Or this type of assets are those assets which neither has physical form nor they have any real value, but on technical ground they can be treated as assets. For example, advertisement paid for 5 years, or preliminary expenses, or discount allowed at time of issue of shares, etc. Then next is liabilities. What is liabilities? Amount payable by business. Here the important word is payable. The amount is not yet paid but is supposed to be paid. So amount payable by the business to others is known as liability. It is a debt or amount due from the business to others for the benefit received by the business unit. So it means that a debt payable by the enterprise in the future in the form of money or goods for the benefit received by the business is known as liabilities. So let's see what are the examples. For example, bank overdraft, creditors, loans, these are liabilities. Now there are different types of liabilities. Two main types are fixed liabilities and current liabilities. In fixed, one of the major source of funds in the business is fixed liability, the liabilities which are fixed in your business. So such liabilities are there in the business for a longer period of time, such as capital, secured loans, long-term loans from banks and from various financial institutions. Then there are current liabilities. So this liabilities arises in the regular current operation of the business. Usually the period of such liabilities is around 1 year, like creditors, bills payable, etc. Then further, there is contingent liability. So this liability means the arrival or the happening of such liability will depend upon happening or non-happening of certain events. Only then you are supposed to pay the amount if such events occur. For example, a worker makes a claim for compensation of rupees 5,000 against the business and a decision is pending in the court. Now, if the worker wins the case, then the business will pay 5,000 to that worker. So the payment of that 5,000 depends on the verdict of court. That's why it is known as contingent liabilities. If the business fails to win the case, then they are supposed to pay. If they win the case, then there is no payment to be due from the side of business. So it may be a future liability for business on happening of an event, that is court verdict.